Hello guys, and welcome back to the channel. If you've been following our previous videos, then you've come to understand exchanges, you've come to understand what it takes to secure your funds and also how to load your wallet with funds. Well, in this video, we're going to throw in more light into what it actually takes to trade the crypto charts. Yes, we've talked about securities, we've talked about so many things, but you need to understand what it really takes to trade the crypto charts, and you need to have these skills on lockdown in your arsenal for you to deliver on the crypto charts steadily and consistently. So our focus is going to be on reading the crypto charts and understanding key indicators. Yes, this is vital for your trading. Well, our previous videos have been talking about meme coins, but the purpose of this channel isn't just to talk about meme coins, but it is to help you grow your crypto portfolio and push you towards success by understanding strategies that can consistently give you profit in the market. Although meme coins might not obey the rules of certain indicators, but having these indicators in your arsenal and understanding how to use them, implement the strategies, can be the reason why you tip up the scales of your profits every time you trade. Indicators like this are more functional and work with more stable assets like Bitcoin, Ethereum, and Solana. I'm going to give you a rundown of what you can learn and what you can expect in this video going forward. We're going to talk about how to interpret candlestick charts and trading volume. We're going to talk about basic indicators like RSI, AMCD, and moving averages. We're going to throw more light into simple technical analysis that can inform your trades and give you a better entry. Furthermore, we're going to give an introduction into time frames, support and resistance levels. And of course, finally, we're going to talk about how we can use everything we've learned in this video right now and combine it with fundamentals, giving you a total overview of the crypto market. So stay to the end of the video, guys. Well, before you can start trading, you need to have the right tools and have the right platform that can actually help you fulfill your trading needs. And what platform is this? Well, my favorite platform, guys, that I love to use every time I'm trading is called TradingView. So you can go check it up. You can go to tradingview.com and check it up, guys. It is pretty simple to use, and every beginner out there can easily sign up for one, get started, and just, own a free account. Now, let's talk about candlestick charts. What are candlestick charts? Why do you even need them? Well, a candlestick chart shows the price movement or price action of a digital asset over a certain period of time. You need to understand that each candle represents a time frame. It represents a period of time in which price action happened. It could be on a 4-hour time frame, it could be on a 1-hour time frame, it could be on a 5-minute time frame. So a candlestick virtually shows the action of people over a certain period of time, different trading actions, different emotional decisions as well over a certain period of time. So a true understanding of candlesticks might change the way you trade and understand the crypto market going forwards. Here is a little thing I want to put out for you so you can understand this in a general view. The candlestick body shows the coin's opening and closing prices during that time, while the wicks, the line that is above and below, shows the highest and the lowest points that price has reached. Sometimes candlesticks turn green, as you can notice, and sometimes they turn red. Well, if you are a beginner and this is your first time accessing the crypto chart, then you need to understand this concept because it is the most important foundation of crypto trading and also making profits. When a candlestick turns green, it typically means that price actually closed above where it opened. And if a candlestick is red, it means that price closed below where it actually opened. Pretty simple, guys. Never forget. This is crucial because it gives you a quick understanding of whether buyers or sellers are dominating at that period. Large big candlesticks often mean that there is a strong buying pressure, while large big red candlesticks means there is a strong selling pressure. So you should watch out for things like that because it gives you more informed information into the direction of where your trades are going. You definitely don't want to be buying when the charts is looking red. Now, there is something very important you need to understand about a candlestick chart, and that's not just talking about the candlesticks. You need to understand the volume. Why is this important? Why is trading volume important? Well, volume tells you how much of a coin was traded in a particular time frame. If the price moves up, it means there is a high volume. It often means a lot of traders are participating in that move, which even makes it more significant. You can compare volume to the amount of action that's going on in the market. Let's say if there is high volume in the market, it means that there is a lot of buying pressure. There's a lot of bidding war going on. Lots of buyers are coming in, dominating the sellers, and making sure that their orders are filled. On the other hand, you need to understand that if price moves up, but the volume is relatively low, it could be a sign that the move isn't as strong, or it could be easily reversed. So what does this mean? This virtually means that if price is actually going up and we got a couple of green candles, but the volume is relatively low, it signifies that the amount of action going on in the market does not equate to the direction in which price is going. This could be a short-term pump. This could mean that price could easily reverse, or it actually isn't going in any real direction. In some cases, we love to call it market manipulation. Yes, this is a situation whereby bigger players, whales, come into the market, manipulate the markets, probably through news, probably by buying more, and use that pressure to get people into the market only to dump it lower. So these are some important things you need to take note. Very important, guys. You need to understand this concept. It's definitely something you want to keep an eye for, because trading volumes serves as a reality check to a trader to understand what's actually going on in the market. What's the sentiment? What's the feel of the market? Yeah, you can see a couple of green candles, but it doesn't necessarily mean that price might be going up. So the volume serves as a measurement of how much pressure the buyers are actually putting into the market. Now let's go over some basic indicators you need to understand in order to serve your time, inform your entries, and also give you more conviction when trading. Understanding these key indicators might be the very reason why you become more confident when trading. The first one we're going to talk about is RSI. Then we're going to talk about AMCD. Now what does RSI mean? This means relative strength index, while the AMD refers to moving average, convergence, divergence. And of course, we have the basic moving averages as well. Don't worry about it, guys. I know it all sounds complicated, but in this video, we're going to talk about it step by step. So you better get your books out and take some notes. Once you set up these indicators on TradingView, you will start to understand how these indicators can help you predict price movements. Now, RSI measures how fast and how far, remember, how fast and how far a price has to move over a certain period of time. Now, we have the ranges from 0 to 100. Let's say we have price action go above 70 on the RSI scale. It means that there is a lot of buying pressure. There is a lot of buying volume as well, that the buyers might reach a point where they get exhausted, and you should be waiting for possibly a reversal, a pullback, or probably a correction. If it's under 30, then the coin might be oversold and you could see a bounce coming. Although this is not some guarantee, a coin might be overbought or oversold for longer than you expect, especially during market trends or hype cycles. Still, RSI can give you a huge advantage when making trading decisions. It also gives you additional data points to decide if an asset is too hot to buy or probably a rebound is just around the corner. Next, we're going to talk about AMCD. AMCD is made up of two lines that reacts to a coin's moving average over different time lengths. When the short-term line crosses above the long-term line, we often call that a bullish crossover. And it could be a sign that price might be turning upwards. When it crosses below, that also means a bearish crossover. That could signal that price is losing momentum. AMCD is handy for spotting momentum shifts, but also remember it's a lagging indicator. So sometimes the signal might actually happen after the price have started to move. You need to be cautious about that. Understanding lagging indicators. So lagging indicators occur after price has already happened. They give you the information after price has moved. You might be saying, but that's stupid. Well, it's not, because when we talk about AMCD, we're referring to statistics. We're referring to data points that can help you understand what direction momentum is going. And by momentum, I'm talking about pressure. We're talking about volume. We're talking about the aggressiveness of buyers to sellers. Now let's go into moving averages. Now, what is a moving average? Moving averages themselves are just lines on a chart that shows the average closing price of a coin over a certain period. We have the 50-day moving average, which plots the average closing price over the past 50 days. And we also have 200-day moving averages, which shows the same amount of information over 200 days, and so on. If a coin's current price is above a certain moving average or closes above a certain, this can indicate the presence of an uptrend. And in an uptrend, you definitely want to be buying. If it does the opposite, that means closing below or the price action continues below a certain moving average, then this can indicate that the presence of a downtrend is here or the downtrend is about to happen. Well, when using moving averages, many traders look for something called the golden cross, which is when a short-term moving average like a 50-day crosses above a long-term moving average like a 200-day, signaling a potential bullish trend. The reverse of this action is called a dead cross. This happens when the short-term moving average crosses below the long-term moving average, which typically is seen as bearish. So how do you use these indicators together to inform your trading decision, find your entries, know where to take your profits, and know when to sell off? The simple answer to that question is called technical analysis. To put this in simple terms, technical analysis is the combination of price action, volume, indicators to understand and also to find conviction in what direction price is going. Probably the uptrend and probably a downtrend. Who knows? The answer is technical analysis. Let's say a coin is showing higher highs and lower lows on a candlestick. Volume is picking up. The RSI is comfortably between 4E and 60, and the AMCD just had a bullish crossover. That's a decent signal that momentum could be on your side. I might take a position there, especially if the broader market sentiment is bullish. Conversely, if you see something like a coin nearing its all-time high with an RSI above 70 plus a potential AMCD bearish crossover forming, it might be a time to consider taking profits or at least placing a tighter stop loss. All of these sounds complicated, but one concept that helps to tie all of this together is called time frame. Different traders look at different time frames depending on their preference. Some traders are day traders, others are swing traders, while others are long-term investors. A day trader might focus on the 1 minute to 5 minute candles to catch the small moves, while a swing trader might prefer the 1 hour to the 4 hour charts. Long-term holders often check the daily or even the weekly charts to get the bigger picture of where price might be moving. If you are just starting out, I'm going to recommend you pick a certain time frame that's going to determine how long you spend looking at the screen. Let's say you can only check your trades once a day, probably because of work or you got other things going on in your life. Then looking at price action on the 1 minute to 5 minute time frame might not be helpful for you. In such cases, it might be better for you to stick to the 4 hour or daily charts so you are not reacting to every tiny price movement. Now, none of this information I'm giving out to you guys would be completed without support and resistance. Well, what does this mean? If a coin has trouble breaking below a certain point, it's called a support. And if it has a problem breaking above a certain price point, it is called resistance. Let me give you a more vivid example of what I'm trying to talk about. If a coin bounced off $100 mark 3 times in the last 3 months, you can call that your support level. If it repeatedly failed to break past $120 price point, that might be a key resistance level. The support level can act like a floor, while the resistance level acts like a ceiling. If price breaks through a significant support, it could mean that price could keep dropping over the long term. If it breaks through a major resistance level, these levels can also indicate that a stronger uptrend is coming. In TradingView, I personally use horizontal lines in order to mark out these levels and have a visual cue of the biases between buyers and sellers. Another factor you want to consider is fundamentals and how it ties in with technical analysis. In crypto, the news and social media have a big part to play on the markets. Yes, because the market is not necessarily made up of machines. They're made up of people making decisions every day. And as you know it, people are emotional. In most cases, a coin's chart might be ready to break out, actually going up in a bullish sentiment. But then all of a sudden, a negative news hits like a major hack or probably a regulatory action. And then the price might just dump despite having all the bullish signals to go up. Conversely, A coin might be sitting at the strong support and looking bearish, but if there is a partnership or probably a major listing, and then all of a sudden the price goes upwards. So you need to understand that information, social media, hype, or any form of mainstream news might affect the crypto chart and boost up or dump its volatility. The key takeaway in all of this is that combining fundamentals and technical analysis might boost your trading decisions, but also give you better confirmations. You need to understand that for you to make this work, you don't have to use only one tool or use one source of information. It's always a combination of different data points in order to make decisions and boost the probability of a winning trade. Although technical analysis is not a crystal ball or a magic spell that you can just whip up on the crypto market and get exactly what you want. It's more like a compass that points you in the right direction and points you in the direction with the most probability for a win. It's all about how you perceive, analyze, and use the informations available to you. Nobody can predict future prices with 100% certainty, and anyone who says they can is probably lying or is involved in a scam. But using tools like RSI, AMCD, and moving averages can help you make more educated decisions rather than just blind bets. It's always a good idea to use confluence trading, which means you're looking for 2 or 3 signals pointing in the same way before deciding to enter or exit a position. It could be a bullish AMCD crossover combined with a bounce off a key level plus a moderate ASI reading. When all of this lines up, the odds of a successful trade is bound to increase. Speaking of successful trades, we cannot end this subject without talking about risk management. Your risk management is very important, guys. Despite the amount of years you spent learning about technical analysis, learning about statistics, learning about indicators, without understanding risk management, which virtually means how you take profits, how you manage your losses, and how you preserve your capital going forward. Risk management can easily make or break you in crypto. Now, guys, I want you to take note of this. Consider using stop loss orders to limit your downside. Let's say you bought a coin at $2 because you saw a bullish setup, but you set your stop loss to $1.80 in case the trade goes against you. That way, you can avoid catastrophic losses if the coin suddenly dips or the market tanks. Similarly, you can set take profit orders when a coin hits a certain price target, especially if you don't plan to watch the chart 24/7. This is especially helpful if you are focusing on midterm trades and don't want to miss your selling opportunities while you are at work or sleeping. When it comes to understanding technical analysis, it all has to do with practice. Practice. Always backtest. You have to practice it day in, day out. You have to picture your trades. You have to backtest your strategies. You have to retest your strategies on the chart just to see if they work over and over on different situations. This definitely draws a huge distance between the novice trader and the professional trader. Of course, you can watch our tutorials, you can read articles about RSI or AMCD, you can even start drawing your own lines, marking up your own support and your resistance areas and testing your theories. You won't get a true feel of the process without doing these things. One thing you can do is to conduct what we call pepper trading or demo trading. This basically means practicing on the markets without using your actual money. Understanding this lets you stimulate trades on your technical analysis without risking real money. It's a great way to test your strategies or to see if you are reading the charts correctly. A common mistake many beginners do is that they load up their charts with lots of indicators. Guys, you don't need to have that many indicators. On TradingView, we got over 100 different indicators. In fact, too many indicators might just be counterproductive and lead to analysis paralysis. A good rule of thumb is keep it simple at first. Start with candlesticks, volumes, RSI, AMCD, and maybe 1 or 2 moving averages. You have plenty of time to investigate and explore other indicators such as Bollinger Bands, stochastic RSI, Ichimoku clouds, and all that. When you're starting out, you don't need all that information because it actually does more worse for you then good. Also keep in mind that different coins react differently, especially coins that are heavily influenced by wealth and social media hype. Don't ever assume that your technical analysis is going to work the same way for every coin on every crypto chart. It doesn't work that way, guys. Different strategies for different charts. Larger and more stable coins like Bitcoin, Ethereum, Solana, Cardano, and XRP might respect technical analysis, unlike new meme coins that keep coming out every day in the market. Otherwise known as shitcoins, are heavily influenced by volatility. If you're looking to do more technical analysis and fundamental analysis in your trades, then you should push your focus towards more stable digital assets. For most of you guys, you don't want to go through the entire process of having to download this much information into your brains just for you to make a single trade. Well, you can shorten the entire learning curve. You can do this by joining signal groups, find a mentor who shares technical analysis pointer, but understanding the basics for yourself is going to help you know why a certain coin didn't do well, or if a coin is going to go up or down, because you understand the basics, you understand what's happening in the market, and having a mentor just serves as an additional aid to your trading process. Towards the future videos, we're going to be coming out with more deeper dives into advanced chart patterns like triangles, head and shoulders, Fibonacci retracements in the later videos. So stay tuned for that. But for now, understanding these patterns can give you an additional information and insight into reading candlesticks, gauging volume, and interpreting core indicators. Make sure to practice proper risk management by setting stop losses and taking profits. And don't forget to keep an eye on major news events that can throw a wrench into your technical setup. Lastly, always remember that technical analysis is just one piece of the puzzle, guys. There's a lot of factors that play into the crypto market when making a decision on whether you should take a trade or buy a token. We got market psychology, we got macro events, we even got social media sentiments that can shift the entire landscape overnight. If you see Elon Musk tweet about a coin, your AMD might not matter at this point. That's why I recommend blending a mix of fundamental knowledge, sentiment analysis, and good old-fashioned technical analysis is definitely the best recipe for success over the long period of time. Keep practicing, start small, make sure you risk what you can afford to lose. Always review your trades, find out what works, find out what didn't, and find out ways you can improve. Well, that's it for the overview on how to read crypto charts and indicators. Hopefully you feel more confident about jumping in on TradingView and making sense of all those indicators and lines. If you think this video taught you something very important, you can hop into our Discord just to get more information. We're going to start some live trading on our Discord once we hit 2,000 members on our Discord community. To join our Discord, join the link in our description below. Keep learning, keep earning, and I'll see you in the next video.